Doug over here at Community Lending Group. So you're ready to buy a home, but your income isn't quite high enough to qualify. The answer could be utilizing a non-occupying co-borrower. So for today's mortgage moment, we're going to discuss this program and how it might be just what it takes to push you over the top to buying that next home. Now, the use of a non-occupying co-borrower can be a beneficial strategy for individuals seeking to purchase a home. In this arrangement, a non-occupying co-borrower, typically a family member or a close friend, agrees to co-sign the mortgage loan with the primary borrower who intends to live in the property. Now, this arrangement is particularly helpful for first-time homebuyers or those who have insufficient income to meet the lender's requirements. Now, one of the key advantages to this option is that it strengthens the primary borrower's mortgage application. By adding the co-borrower's income, assets, and credit history to the equation, the overall financial profile of the application improves. This increased financial capacity can lead to a higher loan amount or more favorable loan terms, including lower interest rates, reducing the financial burden on the primary borrower. Now, additionally, by leveraging the co-borrower's financial standing, the primary borrower can realize the dream of homeownership without having to wait until they can meet the lender's stringent requirements. Now, this option is available for both FHA and conventional loans. However, it cannot be used for a VA loan or a USDA rural loan. Now, when using this option, it's crucial that both the primary borrower and the non-borrowing co-borrower understand the responsibilities and the risk associated with this arrangement. Now, while the co-borrower is helping the primary borrower secure the loan, they are equally liable for the mortgage debt. Any financial mismanagement by the primary borrower, such as missing a payment, could negatively affect the credit score of both parties and jeopardize their financial standings. Now, I'm often asked if it can hurt the co-borrower from future purchases as it adds additional debt to their overall debt ratio. And as I answered before, yes, it can hurt the co-borrower if the borrower is negligent and does not maintain consistent monthly payments. However, if the payments are made on time, most lenders will allow the co-borrower to omit this monthly debt, providing they meet these four requirements. First, the borrower needs to be on the mortgage. Second, the borrower needs to be on title. Third, the borrower will need to document, either through canceled checks or bank statements, that they are the one making the payment for at least the last 12 months. So what this means is the borrower should not transfer the money to the co-borrower and have the co-borrower make the payment. The borrower needs to be the one that makes the payment. And finally, no unsourced funds were deposited into the borrower's account to help them make the payment. The underwriter, they need to see that the borrower's own funds were used to make the payment with no help from the co-borrower. Now, to wrap it up, using a non-occupying co-borrower can be a valuable tool for aspiring homeowners who face the hurdles of trying to qualify for a mortgage, because it allows them to combine their financial strengths, thus achieving their goal of homeownership more quickly and more effectively. If you have any additional questions on a non-occupying co-borrower or any mortgage questions, just give me a call. This is Doug with Community Lending. Thanks for watching, and I look forward to hearing from you soon.